Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we take a look at how markets would have fared for the first half of the year with the first 6 months now behind us. We do so from the perspective of three model portfolios: the conservative, moderate, and aggressive investor portfolio, and their related portfolio allocations. Finally, we share some thoughts on the investment environment ahead and how different investor types may want to position their portfolios. A quick reminder of the three investment portfolios, and turning to our first chart. The moderate investor is prepared to take some risk, focusing on a balance of wealth generation through both capital growth and income, usually with an almost even split between bonds and stocks. The conservative investor, meanwhile, his main investment objective is preservation of capital and generation of income, with limited focus on capital growth. In doing so, there tends to be a bias towards bonds and income-type investments, with less emphasis on equities and riskier type holdings. And finally, the aggressive investor is willing to take a higher level of risk. This investor class places more emphasis on capital growth, with typically higher holdings of equities and other traditionally riskier asset classes. So just how did the different portfolios perform in 2016 thus far? Switching to our next chart, we see that the conservative portfolio was the best performer with returns of 4.1% year to date, the red columns, while the moderate and aggressive portfolios recorded positive returns of 3.2% and 1.4% respectively. It should be noted that this performance is somewhat of an anomaly in terms of the longer-term relationship between risk and return, where portfolios with riskier asset holdings tend to outperform portfolios with lower risk holdings. As an illustration of this, the annual rate of return on the model aggressive portfolio between 2011 and 2015 was 7% per annum, in contrast to the moderate portfolio's return of 6.3%, while the conservative portfolio generated 4.7%. In terms of portfolio drivers, and turning to our third chart, the best performing asset class in 2016 thus far has been US dollar emerging market bonds, up 9.1% year to date. And if you could quickly switch to the next chart. The conservative and moderate portfolios in particular were positively affected by higher weightings of fixed income assets as compared to the aggressive portfolio. Equities as an asset class have offered mixed outcomes so far this year. Local equities, as measured by the TNT Composite Index, retreated 4.7%, while US equities advanced 3.1% and emerging markets advanced 5%. Higher proportions of equities by the aggressive portfolio were to its detriment so far, in contrast to lower allocations by both the conservative and moderate portfolios. The most important question for investors, of course, is where will markets go from here? Local and international markets have been buffeted in the past by a multitude of events, including US interest rate uncertainty, the energy market commodities rout, growth concerns in China and Europe, and most recently the Brexit saga, all of which have contributed to wild swings in the financial markets. Locally, the Trinidad and Tobago economy has felt the pain of lower energy and production and prices, manifested in negative real GDP growth, widening budget deficits, falling foreign exchange reserves, and its first drawdown from the Heritage and Stabilization Fund. The second half of 2016 is likely to be impacted to a lesser extent by the same factors prevailing in the first 6 months. To summarize, the US Federal Reserve has not become any clearer in its interest rate strategy. Brexit, the referendum favoring the UK's exit from the European Union, has introduced more uncertainty into markets, and global commodity prices, while having recovered from their depressed levels of February 2016, still remain vulnerable enough to shift market sentiment from relative calm to chaos in a short space of time. At home, navigating the Trinidad and Tobago economy through recession would be a primary driver of local investor confidence. Revenue generation and/or expenditure containment remain critical to the effective management of the country's fiscal position. While some level of borrowing may assuage the financial imbalances in the shorter term, the longer-term structural adjustments to the country's economic configuration appear necessary. With this outlook in mind, and depending on your risk tolerance and investment objectives, the remainder of 2016 can be viewed as either an opportunity to invest in riskier holdings or a time to practice caution. And turning to our first table, less risk-tolerant investors may opt for more moderate or conservative type portfolio allocations over the coming months, trading off the prospect of high returns for relative safety. For this investor, instruments such as lower risk income type mutual funds, investment grade US dollar bonds, and relatively stable dividend yielding stocks may be preferred. Investors with higher risk appetites and a more positive view on the markets may consider a higher weighting toward riskier assets such as equities, equity mutual funds, and US high yield bonds. While making short-term changes to any portfolio is a useful exercise, the investor should always be mindful that managing an investment portfolio to achieve your goals is a long-term endeavor. Accordingly, we reiterate Bourse's investment themes for crafting a rewarding portfolio in our final table, which include targeting positive inflation-adjusted returns, lengthening your investment horizon, and diversifying your portfolio across currencies, asset classes, and geographical regions. That's it for this edition. For more information, give us a call at 628-9100, email us at invest@boursefinancial.com, or visit our website at bourseinvestment.com. Finally, we at Bourse take this opportunity to wish the Islamic community Eid Mubarak as the holy month of Ramadan draws to a close. Have yourselves a wonderful investing week. This has been the Bourse Report.